But we were not in a recession yet. We didn't have negative GDP growth, but we had decelerating positive growth. So they're kind of playing the narrative game where they're saying we're going to be accommodative, but no, we're not monetizing the deficit. We're not going to, we're not going to devalue the currency significantly. And so that's a really challenging environment. When new houses are cost more to price, that boosts up the price of existing homes as well. Because you say, well, I don't want to wait this many months. I don't want to. Oh, that's going to be super expensive anyway. I'll just buy a house that already exists, and so everybody does that and drives those prices up as well. And I would describe that there's different depths of how bad a supply chain issue is. And so, for example, the lumber spike was well known because it spiked to like crazy levels and then it came down at least most of the way almost as fast. And that's actually an example of kind of a shallow supply chain because we never had a timber shortage. Like we're not shorted on big like chunks of wood. We were short on sawmill capacity, so we had an unusually big demand shift towards suburban and rural homes at a time when we only have so much sawmill capacity, and those operators are not dumb, so they're not going to put a ton of capex into a lot new sawmill capacity when they don't perceive this as maybe lasting too long. So they'd rather just kind of accept the higher prices and enjoy that margin. And so that's an example of a pretty shallow supply chain problem where it can disappear almost as quickly as it appeared once, say, higher prices kind of start taming that demand, or if some of those operators do start to do some capex and expand that a little bit. But then there are other things like semiconductors that are a deeper supply chain issue because it's more global, right? In this world of everything engineered is super complex. If you build a car with 1,000 parts, if you're 6 things short of the car being finished, you're out of luck. I mean, that car is going to get delayed. Now you can be creative and say, okay, we're going to ship this to the dealer and then send them the chips like in the mail a month later with instructions on how to install them. For you can get creative, but it starts to really mess things up. I mean, it's like an exponential system essentially. If you look at periods of inflation, people often say, well, we have inflation because we have supply chain problems or we have constraints in the system. But I mean, every inflationary period has constraints. That's what inflation is. So every inflationary decade we've had is money supply going up at a quicker pace than normal. So monetary inflation combined with real world constraints that if our entire world were software, for example, then if money supply went up, we probably would not see very big changes in price for software because we don't really have a constraint there. But in say the 1940s inflationary decade, you had shortages in commodities, you had shortages in labor, right? Because you had all this extra jobs out there fighting. So that's why you had Rosie the Riveter come in and help build the planes and things like that because you're starved for labor and the commodities. So in the 70s, U.S. oil production peaked, and so we were more reliant on imports at a time when due to the war around Israel, we had those geopolitical issues where we were embargoed, and so you had oil constraints at a time when we also had just gone off the gold standard. We were increasing money supply at a fast rate, and so you had a real world constraint combined with money supply going up at a quick rate. And so that's where we started to run into these rolling issues where we have a lumber constraint, we have a semiconductor constraint. Now, you have affordable housing issues. So there's rent prices are going up, for example, and wherever there's periods of shortage combined with broad money going up, you're going to get periods of inflation or shortages, one or the other or both. So if you take a step back for a second, if you look over say the past 20 years, the United States has grown its broad money supply at a little bit faster rate than Europe, not by much. And both of them have grown their money supply at a much faster rate than Japan. So people often think Japan's printing a ton of money. And so Japan's broad money is actually the slowest increasing in the world. And so if you rank those regions by, inflation, the United States has had the most, Europe's had less than that, and Japan's had way less. And so basically, if you have two economies and they go through this pandemic, and one economy does not do fiscal stimulus, they're going to have a reduction in demand for certain goods because some people are out of a job, people are tightening their belts more, and so there's a reduction in demand as well as a reduction in supply. And so you'll still have these certain areas of constraint that are challenged, but on a broad sense, you probably want to have a lot of prices going up. On the other hand, if you have another economy where they have the same supply constraints due to the issue, but then they also print money and give it to people, then they're going to have demand go up to where, back up to normal or even higher than normal, but supply is constrained. So they're going to have more inflation. And so, and people can debate whether that's good or bad. I mean, basically you'll get a faster rebound in nominal GDP and probably higher consumer sentiment, things like that. But you'll also have more inflation, more constraints. We have a higher rate of people that are paycheck to paycheck, which I think is played into the reason of why we did bigger fiscal stimulus than many other countries, because we had, say, a larger percentage of our population vulnerable to not having a job for 6 months, for example. So that was kind of the consequence of doing that. And I think that would go down, that would go back to like the Ray Dalio long-term debt cycle phenomenon, where, I mean, there were a lot of papers that predicted this would happen in the next downturn, even though obviously they didn't predict a pandemic. They were like, next time we have a downturn, we're going to monetary policy 3, as Dalio would call it, where we're just going to hand out helicopter money, we're going to monetize it, and we're going to hold rates low, even if there's inflation. So it's kind of like we're walking through this playbook. It's almost eerie how much we followed that, and that's really because of a lot of the pre-existing conditions in the system. If you looked at GDP growth rates, it peaked around mid 2018 and started to decelerate. So we were not in a recession yet. We didn't have negative GDP growth, but we had decelerating positive growth. And so they were tightening into a decelerating economy. Back in 2018, they were actually tightening. They were doing quantitative tightening and raising rates. Now it's more just like, do you want to be super dovish or hyper dovish, right? So they're getting less dovish rather than actually tightening, which is you're tightening rate of change terms, but you're still not actually tightening. So they have a higher chance of getting away with some of that because they've already, we're seeing so much reverse repo activity in the market. There's basically banks are stuffed full of cash. Other financial institutions are stuffed full of cash. There's collateral shortages in the treasury market, in part because the Fed bought so many of them, and also because the debt ceiling and the TGA drawdown, so that the Treasury has issued fewer treasuries than they otherwise plan to do by this point because they're constrained. And so you have a treasury shortage. So if they were to buy fewer treasuries, it actually probably wouldn't be the end of the world for a period of time. I think they have some runway to actually taper to some extent. But they clearly want to push that as far as they can before they go. The other challenge, the reason I wouldn't want his job, is because, again, going back to the long-term debt cycle thing, when debt is this high of a percentage of GDP, you pretty much need a long period of negative real rates in order to make the numbers work. And so it's kind of like you got to inflate away the debt without saying you're inflating away the debt. And so they're kind of in that situation now where they were kind of like pseudo, gave up independence for a period of time, monetizing debt, doing everything they can, but they don't want to give that illusion that they're just going to inflate away the debt, have people lose confidence in the currency. So they're kind of playing the narrative game where they're saying we're going to be accommodative, but no, we're not monetizing the deficit. We're not going to, we're not going to devalue the currency significantly. And so that's a really challenging environment.